And I'd like to welcome everyone to Money Show's virtual expo for accredited investors. We are pleased to welcome Mike Turner, President and Chief Portfolio Manager of Turner Capital Investments, LLC. He has a strong financial, mathematical, computer science, and engineering background. He takes a disciplined, rules-based approach to trading through the use of his unique market directional investment methodology. Mr. Turner is the author of the widely read and popular books, 10 The Essential Rules for Beating the Market, and Rule 1 for investing, the distinct differentiator between Turner Capital, a fiduciary, and all other traditional money management firms is that his primary objective is to increase client wealth in both bull and bear markets. Mike, thank you so much. It's all yours.
Thanks, Mark. Hello, folks. Glad you are tuning in this morning. Have a lot to go over, and we're going to have a Q&A session at the end of the presentation, and we'll get you a link to that so you can move over to that. We can kind of have a chat room, if you will. So let me take you into the process. I'm going to take you through our updated TMI Total Market Index methodology or strategy. It's basically designed to, in a well-defined bull trend, move up twice as much as the market does. In a well-defined bear trend, it'll move up actually 3 times better than what the market does, because the market goes down. The market goes down 30%. And then theoretically, it doesn't do this exactly, and I'll explain that in a little bit. It'll get close to 2 times up, so that's 3 times beating the market. Now, I'm going to tell you something else. I don't have a slide for this, but I'm going to kind of thinking about this as we were getting ready to kick off. I'm going to talk a lot about 2x leverage type ETFs for the S&P 500 and the NASDAQ. And being savvy investors, which you are, I'm confident that you have heard wrongly, but you have heard that these 2x leverage type ETFs are high risk. They are not. Some of them are. The 2 I'm into are not at all. And I'll explain that to you. The other is that they don't do what they say. They don't actually get 2 times, and no, they don't, because they just do it during the day. They don't hold overnight. So that could be good or that could be bad for the index. If the market goes up a lot overnight, they don't get the benefit of it. If the market goes down a lot overnight, they don't get the benefit of it, or the negative aspect of it, depending on whether it's an inverse or not. But you don't, in my opinion, don't worry about the fact that I'm using leveraged ETFs. I think you'll find out over time that they're quite a benefit to growing your capital. So let's get into it. All right, hang on, let me get the screen where I want to. All right, first of all, past performance is not a good indication of future returns. It doesn't matter whether it's actual trading or back testing, so keep that in mind. So here's the truth about market pundits. You know, you turn on CNBC or Fox Business, or read the Wall Street Journal, for that matter, any of the the places where you're going to get information from, output from various entities that are going to tell you about what you should think about doing because of what they're saying is likely going to happen. That is a waste of your time, period. They don't know what's going to happen. No one knows what the market's going to do in the future. Not tomorrow, not next week, not next month, not in the next quarter, not in the next year, not for the rest of your life. They don't know. And their opinions are just opinions. They're just guesses. And I don't like investing my money or my clients' money into a guess. So I don't guess. And what's more, I don't care what the market does tomorrow. Market's booming today. All my clients are moving up. Great today. We're 100% in the market. We're long, and we're 2x long for most of my clients. And so they're going up twice as much today as the market is. That's great. What if the market goes down tomorrow? Well, I happen to know that if it drops a certain specific percentage, because I have a mathematical formula for that, and it's not much, less than 2 or 3%. If it drops that tomorrow, we go to cash. So I'm not worried about what this market's going to do. Anyone who says anything about what the market's going to do, likely to do, may do, they're just guessing. 100%, not 99, 100% of all newsletter writers who proffer their advice about what to buy or sell based on what the market or the economy or the currency or the Fed or politics, doesn't matter, demand or lack thereof of anything is going to do in the future, they're just guessing, all of them. They're not telling you any facts, they're just guessing. Now, they might tell you, well, this has happened and this has happened, and those are good facts, great. History's good. But they're not going to tell you that because of those things that have happened in the past, that there is even a high degree of probability they will happen in the future. Here's what you know and I know. The market's going to go up and the market's going to go down in the future. Now let's capitalize on that. All of the financial news, including opinions of economists, analysts, fund managers, segment so-called experts, all of that information that you're reading and you're poring over and you're watching, drinking your morning coffee about what's going on, that is just noise. Okay? The only thing that you can 100% rely on, now this is important, is knowing where the market is right now. Everybody knows that. That's what you should focus on. And it's a mathematical fact that the current trend in the market, which right now is booming higher, that current trend in the market will last exactly until it doesn't. Now, as stupidly simple as that sounds, that is profoundly important. If that is a fact, and it is, it's a mathematical fact, the current trend will continue until it doesn't. What do you think would be a really good thing to know? When that doesn't, oh, I know what you're thinking. When that doesn't will occur. No, you won't know that. You can guess, but you'll want to know when that doesn't has occurred. Has. And you're saying, well, Mike, that's after the fact. Oh, it is. But not so far after the fact that you can't get nicely out after a big profit. Yeah, you lose a little bit at the top, but it's not a lot. And you don't have to sweat bullets trying to figure out when that's going to occur. I have clients, although I am doing as good a job as I can do to get them to quit thinking this way. Oh, they'll call me up from time to time and they'll say, oh, Mike, I just read, I just heard, I just whatever. And I think the market's going to do this, that, or the other. Okay, what? And they're in a panic. You need to stop that. There's no panic in my life. There's no panic in any of my clients' life if they understand what I'm telling you. With this methodology, you don't have to worry about what the market's going to do. You don't have to worry about who's going to win the election. You don't have to worry about anything going forward that's going to impact your investment in the stock market, because you don't have to worry about that. Okay. So let's just say that you'd like to kind of know what the collective wisdom of the entire market and how to trade this market right now. What would that be? Well, I'll tell you, it's on the next slide. Okay, the collective wisdom of the entire market and how to trade this market right now, based on that collective wisdom, is on the next slide. Now, spoiler alert, this is probably going to underwhelm you a little bit, but this is the truth. You see that chart? That chart is what we call our total market index. It is comprised of the S&P 500, the NASDAQ, the Russell 2000, and the Dow. Well, I'm not going to go over all of this information back here all the way to where we started running this strategy. I'm going to talk a little bit about the last couple of 3 years, but right now, I'm sure you're interested in the current trend, okay? And what is that current trend? Well, it's just a rocket ship going higher. Oh my gosh, could the market be getting overbought? Oh no, is the Fed going to keep raising rates? Oh no, what's going to happen here, there, whatever, it doesn't matter, okay? What do you know about that trend? What do you know about that green arrow? You know how long it's going to last. I've just told you that. It's going to last until it doesn't. Okay. So the position and trend of this chart is the result of the collective wisdom. And that's what it is. When you look at that black line, that's telling you what the millions of investors and traders and hedge funds and major financial institutions and on, that is the cumulative position that they have taken, and it's reflected in the four major indexes: S&P 500, the NASDAQ, the Russell 2000, and the Dow. So that's their thinking. That's what they're buying. When you're looking at the market, that's telling you how bullish or bearish they are on the market. And if that's the case, it's good to know that. How long will that last? Oh, don't shake your head and say nobody knows. It'll last exactly until it doesn't. The moving average of the TMI, along with various trend lines that are monitored, we monitor them, and continually tested with regard to the rules that govern when to buy and when to sell. And we have some very, very sophisticated rules. One of the things I'm sure you have learned, every investor knows this. First of all, you should have rules for how you buy and when you buy and what you buy, and how you sell, when you sell, what you sell. You should have rules about that. And if you don't have them written down, you've got them in the back of your head, but you need to have them written down. And then you need to have what's really important. The rules are important, but they're not nearly as important as the discipline to follow those rules. Come heck or high water, you want to follow those rules with discipline. And if the rules are wrong, change them. But don't violate your discipline to follow them. Okay. And of course, the current trend will last exactly until it doesn't. So here are some trading rules that we follow. We buy when the rules indicate the probability is high that the previous TMI trend, that's the total market index trend, has ended and a new trend is beginning. Continue to stay in the trade as long as the TMI trend stays the course. You notice I'm not talking about what to buy. What to buy is kind of a secondary thing. It's knowing whether or not you should be buying, should be selling, should be in cash, or not. You stay in the trend, in the trade, as long as it doesn't violate the reason that you got in. You want to ignore volatility. Oh my gosh, how can you do that? Well, I call it the Buffett rule. He's famous for a lot of things. One is this quote: "We regard volatility as a measure of risk to be nuts." Well, you might say that's nuts, but he is, by his own admission, the greatest portfolio manager the world has ever seen. So maybe he knows a little bit about what he's talking about, although he buys companies, not so much stocks. But in any event, there's a lot of truth to that. Volatility can be noise. Volatility does not necessarily mean a change in trend. It'll have an impact on trend, but it is not the trend. Volatility is not a trend. Sell when the rules indicate the probability is high that the TMI, total market index, trend has ended. Not will end, has ended. Buy, and in our case, we buy leverage 2X index ETFs at the beginning of a TMI bull trend and at the beginning of a TMI bear trend, the inverses. What's an inverse? It does the opposite of the index. Okay. I'm going to even tell you what indexes that we focus on here in a minute. So here's a little blow up of the TMI chart. Go back to 2019 and take it up to pretty close to current. So here's that green shaded area says should have been long the whole time. Well, that's almost all of 2019 and a little bit of 2020. And then you see the big fall off, and that's the COVID impact. Now, I want to show you something here. Notice we didn't get out here. Why didn't we get out there? Instead, we got out right over here. Okay. We lost a little bit of money. We lost from here to about there. Well, we also at the same time made all of this money going up. So we lost a little bit at the end. Because why? We had to wait until we knew this trend had ended. Okay. Now, we didn't know COVID was going to do this to the market. Okay. So we go to cash right about in here. Then we get our next buy signal way down here. Okay. And we ride it all the way up. Oh gosh, wouldn't it have been nice to get out right there at that spot right there? How would we know that that market's not going to just keep right on going? We don't know. At this point, we're saying, when has the trend ended? Well, it ends right about there, if I get my cursor to come on. So we lose a little bit at the end. We didn't get in right down here at the bottom either, did we? Why not? We didn't know that this trend had ended going down. We knew that it had ended when it moved back up this much. Okay. Then we get into 22. Oh my gosh, what a head knocker that was. So we are ended, we're out, and these are red shaded areas because we're in inverse ETFs. Then we get into 23. And we're rocking and rolling in 23, and it hasn't ended yet. In fact, this chart's a little bit dated. I take it through the 7th right now, that's quite a bit higher than that. All right. So how good did all of that trading do? Well, in that first green shaded area, okay, that's our first trade in this particular view, we're up about 56%. This next one, we're up about 220. This next one in 22. You remember 22, right? How well did you do last year? Market was down almost 20%. The strategy here up 45. And then we have where we are now, which up about 36% so far. And what's the market? It's up what, 11 or so, 12? So the key to capital growth is detecting when to go all in and when to move completely to cash. And by the way, you see these trades down here on the screen where we're green and then red. We're not a little bit in the market. We don't tiptoe into it. Well, let's see if it's really there. Let's put 10% of the money to work and we're all in. Now, all in what, you might be asking? I'll tell you that in a minute. So here's what we do. Buy here, sell here, okay? Buy here, sell here. All in, all out. And then you got several of them here where you buy, sell, buy, sell, buy. That's where we are right now, okay? And there's the returns, which are, I would have to say, pretty impressive. All right. Now, here's the summary. I've got about 10 minutes left. So this is the amount we're up, and this the TMI strategy is here in the middle, and we're in the 2x ultra of the S&P 500, 50%, in the 2x ultra of the NASDAQ, 50%, and it's the inverse of those when we're in a bear cycle. So we had an average over the last 18 years or thereabouts of about 47%. The S&P 500 has an average of about 8.5%. Okay, so it's important to know the following: there were no changes made to the algorithms over the past 17 years, 18 years actually. No curve fitting. Okay, the TMI strategy outperformed the S&P in all but 1 year. It was 2012, and we just barely got beat that year. Trading the S&P 500 NASDAQ to its ultras, ETFs beat the market on average by over 550% for the time period. Actual trading began on March 31 of this year, and currently the TMI strategy is up, well, now over almost 23% as of today, and the S&P 500 is up about half that. So here's what it looks like on a chart. And so I can't promise you that we're going to continue to do this well going forward, but this methodology is really fun to play with and fun to invest with and fun to watch what it does for my clients. I have spent nearly 25 years in the development of this strategy. It has taken a lot of trial and error. Last year, we got our butts kicked. Okay. I didn't have this strategy last year. And so you're saying, well, where are you getting this information? Well, we back tested it. And, but this year we're running it for real and we're blowing the doors off with it. So it's very impressive. It's got a lot of work into it, thousands and thousands of man hours that we put into this in testing and running it. And so it's quite impressive. So here's some statistics. Total years 18, bull bias trades, we were in the SSO and QLD. Those are what we would buy in a bull biased environment. When we go into a bear market, we buy the SDS and the QID. These are 2X inverse ETFs. The SDS is the QID, and the SSO and the QLD are 2X period. There's no inverse in them. The total round trip trades, 56. But keep in mind, we're buying and selling 2 tickers during that period of time. So there's actually 2 trades. But round trips means we have a buy date and a sell date. And notice that the buy date and the sell date comes from the TMI. It does not come from the S&P 500. It does not come from the SPY or the NASDAQ. It does not come from that. That's not where the trade signals are generated. That's what we're buying and that's what we're selling. But the signals don't come from those indexes. They come from the TMI. Total winning trades, round trip trades 46. Average gain per winning trade is about 35%. Total losing trades 10. Average loss is about 3.4. Total losing years none. Average drawdown per trade, meaning at fluctuation, that's volatility, about 4%. Worst drawdown was about 15%. Long trades 64%. Short trades, and again, they're really not short. We're buying a long position in an inverse ETF. Average gain per year about 47.5%. Biggest winning trade 177. Biggest losing trade minus 7.8%. So those are the stats. So here's how the rules work. We use a 5-week moving, this is going to be really geeky, and most of you don't really care about this, and I understand it, so bear with me. We use a 5-week moving average, the 10-week moving average, the 20-week, the 40-week, the slope of these trends, the current 5-day moving average of the TMI, various standard deviations, and the TMI histogram. These data are analyzed via very sophisticated computer algorithms, including artificial intelligence. The buy signals are generated when the above data indicate a well-defined longer-term trend is likely developing. Buy signals are generated on the weekend and closes. Sell signals are generated when the above data indicate a well-defined trend is counter-trending, meaning bearish, regardless of current volatility. And the goal is to stay in a well-defined trend, bull or bear. If I'm not managing your money, you're managing it yourself. Let's say you've got another manager out there and they're doing the best job they can for you. I'm sure that they are. Just go ask them this one question. What are you going to do for me in a bear market? And then don't say anything. First of all, there will be a long pause. Probably they will say, well, we don't change anything. They probably got you in some kind of 60-40 split, 60% stocks or bonds, and then 40% bonds or stocks, depending on which side of the age group you're on, and they don't change. They're going to say, we have you in a well-diversified portfolio. We don't change based on what the market's doing. Well, good for them. Even good old Warren Buffett loses 50% every decade or so. So if that's okay with you and you don't mind losing a ton of money in a bear market, stay with what you got. All I'm saying is that I don't do that. I don't do that. I want to make you money in a bull market. Most of the time I'm successful with that, particularly with this methodology I've got. Way most of the time I'm successful with that. I want to make you money in a bear market. not by shorting the market, but buying long positions in short ETFs. Okay. So that's the way we make money for clients in a bear market. And we and my clients ignore volatility to a point. So you may be asking, just what are the dadgum rules, Mike? Well, they're proprietary. Can't tell you that. All the rules are based exclusively on the TMI, Total Market Index. We do not analyze, do not care about what the technical or fundamental, for that matter, condition of the underlying holdings are. Okay. We buy when the rules are being applied to the TMI tell us to buy. We sell when the TMI tells us to sell. The rules are applied. The rules applied to the TMI tell us when we are in a well-defined trend and not. Okay. So here's how to get started. I've got just about 5 minutes or so left. Go to Turner Capital and click on the link that says click here to start the onboarding process. Or you might say, well, I'm not ready to do that yet, Mike. I think I've got several questions I'd like to ask you personally. That's fine. On that same page, when you go to the website, on the home page, there's a way for you to click on my calendar. You pick a day and a time that's open, and I will call you. I will personally call you. Not somebody else, I will. And you and I can talk about it. Okay. But if you click on the onboarding, you can fill in the form. We'll send you account opening documents. It's going to be at your funds will be held at Schwab. And here's the thing: this does not go into a fund. It doesn't get commingled. It stays in your name, your account. You're in control of it. Right? All you do is give us limited trading authorization to make trades in your account. So it's a very easy thing to do. Yes, we do IRAs. Yes, we do Roths. Yes, we do trusts. Yes, we do charitable remainder trust, whatever. We do them all. Okay. We can manage any kind of money that you've got now, almost without exception. And but again, it's going to be held was at TD Ameritrade. We're now moving to Schwab. As you know, TD Ameritrade, or Schwab purchased TD Ameritrade. Anyway, if you have questions, you can set up a time, like I said, for me to call you. So I'm going to chat here for a minute while this disclaimer is up, and you need to commit this to memory. Just kidding. But it's a requirement. I'm a fiduciary, and that means that there's only certain things that I can say to you or not say to you based on what the law says I can and cannot. So I can't lie to you. I cannot promise you a return. I cannot tell you that you could only make money with me and never lose money. I can't say any of that to you, which is all true. There's nothing we say or do that's not true. So Mark, I don't know if you've got any questions that anybody has asked, but if you do, now would be a good time for me to address them.
All right, Mike, thank you so much. Fantastic presentation as always. We had a viewer here. They're wondering if they invest in Turner Capital now, would their money be put in portfolios now or wait for the next signal to get it?
Oh, that's a great question. And the answer to that is it's a game day decision. Generally, I make that decision on a weekly basis, sometimes more often. We don't know, no one knows whether or not this trend we're on was going to last for the next year or not. I mean, you saw some of the history, and some of these trends last well over a year. And if they do, we want to stay in them the whole way. This one we're in now is running about 3.5 months. So it's relatively young, but there's a lot of trends that don't last more than 4 or 5 months. So no one knows whether we're close to the end or not. But each week I look at the data and determine whether or not the risk is too high to do what we call rebalance, which means anybody that has opened up an account and put money into that account for the TMI and or added new money for the TMI, I will let my my trade team know whether or not it's a good week to rebalance and to put them in sync. So if you put your money into an account for us to run for TMI, you have a choice. You can say to us, leave me just in a high yielding money market until the next trend starts. And we'll do that. Okay. Or you might say, put me in to the model as soon as you guys decide it's okay to do that. And we'll do that. Now, if we decide to rebalance, that doesn't mean it's 100% probability that the trend is only going to continue, but it looks more favorable than not that it will. So that's what we do by analyzing the data.
All right, thank you very much. We had a couple of viewers here. They're wondering, is this a similar TMI to the cycle profit TMI?
It was similar. The genesis of this that we had in cycle profit really was something that we were watching kind of as an ancillary chart for a long time. It has evolved, particularly with adding the histogram to it and the rules that we have. So yes, on this standpoint of the structure of the TMI chart being a mix of the S&P 500, the NASDAQ, the Russell 2000, the Dow, that's been there for a long time, many years. And it was in the cycle profit. For those of you who don't know what cycle profit is, it was a subscription-based business that that I started, I don't know, a decade and a half ago. But in any event, yes, that's the same chart.
All right, perfect. Mike, just to wrap us up here, we had someone complimenting you. They wanted to say that they compliment you on your weekly newsletter. Great informative read. They never miss. So just wanted to put that out there. Good words.
Thank you.
And
thanks, guys.
Also, there is a Q&A session that will be held. Thomas did paste that link and password in the chat, so be sure to check that out. Mike, as always, thank you so much for being here. Greatly appreciate you.
Yeah, you bet, Mark. Thank you, sir.
All right, have a great one.